Today we're going to talk about tips for how to improve your investment experience. Hi, I'm Scott Hamilton, Certified Financial Planner. We're fee-only and fiduciaries. We have offices in Austin and Houston, and we help people plan for retirement. Okay, so today we're going to do something a little bit different. We're going to talk about a dimensional deck here, and we put it together, and it just basically outlines a few broad-based generic topics that you should consider while you invest. Number one, the stock market. So it says all available information. The world market is 1.1 trillion traded as a daily average, right? And then all the information available, this is the efficient market hypothesis, says that the semi-strong model says that all information is available in the prices, and the prices you can tell so much from the price of an equity or of a bond, because all the information globally instantly is incorporated in that price. Now, granted, there's anomalies and errors, but generally speaking, that's true. And that's been lots of research backing that up. So it's just market pricing. Okay, don't try to outguess the market. All right, so what we're saying here is that the stock, we'll just look at the stock up here, stock funds. There's 3,000 stock bond funds and stock funds that started in between 2006 and 2025. That's 3,000. And the ones that were the top performers, there's only 12% that survived. So that's number one. These funds just don't really last that long. And then again, it's saying, again, these stock funds, the top 25%, only 23% of them continue to be top performers 5 years after. So the comment here is resist chasing past performance, right? So don't anticipate the market. Don't chase past performance. Past performance is no guarantee for future performance. And this is clearly showing that the top 25% of performers, only 23% of them were in the top 25% 5 years later, okay? So it's hard to pick the winners, and it's hard. Let the markets work for you, right? So that's the topic of this. So it's just saying, if you put $1 in from 1975 to 2025, it's going to grow to $780 if you're small caps. But if you're in treasury bills, it only grows to $9. It matters where you invest, right? So you want to have a diversified global portfolio, but realize that small caps have a role too, not just large growth stock, which everybody's so into now. Now, there's a lot of academic studies that says that you can target higher returns, which is the title of this slide. And one of the things is called the three-factor model by Fama and French, and they focus on small companies, value stocks, high profitability. Over time, globally, like over the last 30 years, this has proven to be a winner of an idea. Target higher returns, okay? And diversify internationally. S&P 500, one country, 500 companies. That's, the U.S. market. It's great investment. No problems here. But I would say that maybe you should include some other countries, like 47 others, right? And then you end up with 8,100 companies instead of 500 companies. So you're investing in the best companies in the world when you go into the global market index, not just the U.S. Remember, the U.S. has only got 60% of economic activity in the globe. The total world, you can bring in more. It brings in more diversification for you. And avoid market timing. We've done a whole video on this. It's a loser of a strategy. You have to be right twice. So notice if you miss, so this is the growth of 1,000 invested from January 2001, okay? And if you miss the 1 week, your return drops from 8,300 to 6,900, okay? That's number one. If you miss a month, it drops to 66. You miss 3 months, it drops to 5,800 from 8,300, right? So big drop. If you miss the top 6 months, so let's say, you know what? The market's really high. I don't feel comfortable. I think we'll sit in cash for a few months, and that few months turns into 6. You're cutting your returns from 8,000 to 5,000. Significant returns. Time in the market is a very difficult strategy. I would encourage you not to do that. Manage your emotions. So this is a cycle. You know, it parallels the business cycle. We go from optimism to greed to fear back to optimism. So, you know, manage your fear. When the markets go up, you don't necessarily change your allocation to be more aggressive. And when the markets go down, avoid, you know, becoming more conservative at that point, because that locks in your losses. And the financial press is addictive and misleading, and if they knew what they were doing, they would be doing it themselves instead of talking about it. There's just a lot of noise out there with the financial press. The top 10 funds to own now, buy stocks for the coming recession, it's time to bet against oil, the investment that's safer than cash. These are all lead magnets, and they're all trying to grab attention, and it's a loser of a strategy. Be very careful of too much news, financial news. And then control what you can. And this is the last slide. Control what you can. Create an investment plan. Everybody needs an investment plan. Structure a portfolio along the expected returns. Diversify globally. Manage expenses, turnover, and taxes. And stay disciplined through markets' highs and lows. So these are some really broad, high-level tips. If you'd like to chat a little bit more about these, please click below to our website, Hamilton Financial Planning, and click us a Get Acquainted meeting. We can chat about this. I can send you this deck and answer any questions that you may have. Thank you for taking the time to watch. Appreciate it.